This is how to get an over 80% win rate without guessing the direction of the market. We don't care what's going to happen. We don't care whether price goes up or down. We are still going to win over 80% of the time. And I'm going to show you exactly what you need to do step by step. So the first thing is you need to open up a watch list of things that you can potentially trade. This is just a default watch list made by the broker that I'm using. You can make your own watch list. It doesn't matter what's on here. Just make sure it's nice and diverse, a nice selection of things to trade. And you want to make sure you have IV rank on your watch list, and you want to order your list from high to low IV rank. That's very important. And then you also want to filter out anything that has earnings over the next 45 days or so, and you want to get rid of anything that's not very liquid as well. And once you've done that, you'll be left with something that looks like this. And from what's left, you only want to look at things to trade that have an IV rank of at least 30. So in this instance, our cutoff point would be at the British pound futures. Anything below this we wouldn't look at. Now in this case, we are going to take a look at GDX. It's trading at just over $45 a share. It has a nice IV rank of 51. It's not too high, it's not too low, and it has an IV level of 34%. So once you've selected your underlying, you want to go over to where you can see a list of option expiration dates. This is because we are going to be selling or writing options contracts, and you want to pick an expiration date that's between 30 and 60 days out. 45 days is perfect, but whatever you choose needs to be a monthly and not a weekly or quarterly expiration date. So we've got 45 days out, May 16th here, a monthly expiration. So we're going to open that up, and now we can see the options chain. So we have calls on the left, puts on the right. This orange horizontal line shows us where the price of GDX is with respect to these strikes going down the middle. We also have this vertical orange bar that shows us the expected move of GDX over the next 45 days. If your broker doesn't display the expected move, it should be in the top right in parentheses next to your IV or somewhere, in that area. As you can see here, it's plus or minus 3.69 right now. And you also want to make sure you have delta on your options chain as well. So let's just take one step back and understand why we are selling or writing options contracts as opposed to buying them, which is what most people do. So if you were to buy a contract, so let's say if you thought that price was going to move higher, and let's say you thought price was going to be at, say, $55 in the next 45 days, you might pay $1.16 and buy this 48 strike contract here. And what's happening is, in this instance, you need price to move higher than 49.16. Now, the reason why that is because the strike is 48, but you're paying $1.16, so that gets added on, because once you've paid the premium, you never get that back no matter what. So that gets added on. So as you can see here, this red line shows us anywhere in the red zone, that's a loss. The gray area is your sort of scaling break-even zone, and then the green area and above is your profit. So in this instance, price is currently at $45. If price goes lower, you lose. If price stays where it is, you lose. If price goes higher, but not higher than 49.16, you lose. Only when it goes past 49.16, you start to make money. And so there's only really one win condition here, and that's shown by our pop in the bottom left, which is 25%. So you've got a 25% chance of making money. Pop means probability of profit. Now, if we were to do the inverse and sell this exact same contract instead of buy it, now if you look at our pop, it's 75%. Okay, because what's happening here is we're taking the other side of the trade and we want the opposite to happen. We want price to stay away from our strike. So if price stays where it is, we make money. If it goes lower, we make money. If it goes higher but not above 49.16, we make money. So we have a lot more win conditions, and we only start to lose money above this 49 area here. And this is why we choose to sell contracts, because you have a much higher probability of success. That's just one of the reasons of many. Okay, so In this instance, now that we understand why we sell contracts, and we understand that we want price to stay away from our contracts, what we can do is we can use expected move to determine where we should sell our contracts. So all we need to do is sell outside of the expected move to get a high probability of success. The further out you go, the higher your probability of success will be. However, the less return you'll make because you are taking less risk. And I like to be between about 15 and 20 deltas on either side. So if we look on the delta column, on the call side here, we have an 18 delta at the 51 strike, we can sell that. On the put side, we have an 18 delta as well at the 41 strike, we can sell that. And now what you'll notice is that we've created a range for ourselves here between 41 and 51. Okay, and as you can see, this is our green zone here. Anywhere within this green zone, we make money, and that far overshadows the expected move bar here, which is going to give us a high probability of success, which is currently 71%. Okay, and that's if we hold until expiration, which is something that we very rarely do. And what's actually more likely is to get out of this position at 50% of max profit. And if we do get out 50% of max profit, we have an 84% chance of making money, as you can see here with this P50. So we are now getting an over 80% win rate on this trade. So if we look at the numbers, we would collect $1.02 up front per share. So that's $102 up front that we would collect on this trade. And our broker is going to require $466 in buying power to open this trade. So we're getting a return of a little under 25%, which is really nice and high in 45 days time, with, you know, an over 80% win rate or probability of success here. And this is basically what the trade setup looks like. You want to do this again and again and again, as many times as possible, have as many occurrences as possible to be able to eliminate short-term variance. And as long as you are doing this consistently and keeping your position sizing small, you will make money over time. Even if you don't make any adjustments or roll or anything like that, you will still make money. And if you do make adjustments, etc., you will make even more money. Now, what is an adjustment? So let's say, for example, if we started off with this position here, price moved down to 40, we're at risk here of losing money on the put side. What we can do is roll down the call side, and what you'll notice is that you can see this green bar kind of moving along with the market. Okay, and that's kind of what we want to do. We just kind of, in the 1 or 2 times out of 10 that a position moves against us, you can deploy risk management protocols that will allow you to turn a losing trade into a break-even or even a small profit. But even without doing that, this is still a profitable strategy, as long as you're getting out at about 50% max profit, or sort of around 21 days till expiration, about basically halfway, either on your profit side of things or on a time basis. You want to get out about 50%. Okay, so that's the setup. That's what it looks like. If you obviously you do need to keep your buying power in check, and your position sizing, and we have created a free position sizing template to help you do that. The link is in the description, and the way it works is you enter in the size of your portfolio. Say if you had a $15,000 portfolio, you enter that, and then you enter in whatever the VIX is. So say if it was 12.6, you enter that, and then everything, as you can see, is going to be calculated for you here. And it's going to tell you exactly how you need to structure your portfolio. So I'm not going to go through everything here, but just as an example, what we showed you in this video is an undefined risk position. So if we look here, maximum amount of buying power to allocate to a single undefined risk position. This one here, sorry, not the bottom one. As you can see here, it's saying that the maximum we should be allocating to a position like this in this example portfolio is $1,050, and our buying power requirement here is 468, which fits perfectly in our portfolio. So this would be a position that you might look to put on. Now, if you would, so basically that's how the template works. If you would like to learn in more detail about what we do and how we do it, click on EDS Premium, get yourself signed up. Once you are inside, you will have access to this portfolio that I showed you an example of, where you'll be able to see the positions that we place, how we manage risk, how we make adjustments, etc. All of that is shown in real time, so you can either copy or reverse engineer our trades and use it to study. It's up to you. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so you can speak with myself directly or with other like-minded individuals to share ideas, or if you get stuck or anything like that. There's a 100% money-back guarantee as well, so once you have been through the full course, follow some of our trades. If after 6 months you're not profitable, then we will work with you for free until you are, or you can request a full refund. So it is completely risk-free. It's $9.99 a month to join. The price will be increasing, but once you're in, it's locked in for you for life, so you are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. Once you've learned it, no one can take it from you. It's a very powerful thing to know. And we aim to get you to that point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.